On October 24, 1929, thousands of people physically rushed to Wall Street. They stood shoulder to shoulder outside the New York Stock Exchange, desperate for news about the money they were losing by the second. Fast forward almost a century, and the physical crowd is gone. The sheer panic remains exactly the same, now playing out in the glow of a dozen monitors. A stock market crash is a rapid, uncoordinated contraction in asset valuations. It's a rush for the exits driven by fear, wiping out trillions of dollars in paper wealth in a matter of days or even hours. When we see those numbers free-falling on the news, the immediate assumption is that a collapse on Wall Street guarantees a widespread economic depression for everyone else. History certainly gives us reasons to fear. That 1929 crash eventually erased 89% of the market's value, and the cascading effects pushed a quarter of the American workforce into unemployment lines. But then there is October 1987. On a day known as Black Monday, the Dow Jones plunged nearly 23%, the worst single-day percentage drop in United States history. Yet despite that record-breaking plunge, the 1987 crash resulted in almost zero long-term damage to the real economy. Why do some spectacular market collapses devastate millions of jobs, while others leave the everyday economy completely unscathed? To find the answer, we have to look past the flashing red numbers on the exchange floor and examine the hidden plumbing of the global economy. Every market crash requires a unique catalyst to puncture the prevailing mood of speculative euphoria. In 1929, that bubble was inflated by human greed. Retail investors borrowed heavily on margin to buy stocks, stretching the market until it simply snapped under the weight of its own debt. Today, the triggers are often hidden in code. Algorithms and high-frequency trading programs can react to a single piece of bad news, executing millions of sell orders and creating automated panics without human intervention. Sometimes the catalyst comes from entirely outside the financial system. In early 2020, a biological virus forced a sudden global economic shutdown. Whether the trigger is margin debt, algorithmic feedback loops, or a pandemic, the initial drop is just a spark. What actually matters is what that spark lands on. If that spark lands on a financial system that is over-leveraged and structurally weak, we get path A, contagion. When asset values collapse, the net worth of banks and corporate borrowers evaporates. Lenders are suddenly holding toxic collateral. Unable to distinguish healthy borrowers from insolvent ones, they do the only thing that makes sense. They stop lending entirely. The credit market freezes. Without access to daily funding and commercial loans, normal businesses cannot meet payroll or fund operations. They are forced to shut down, sparking mass layoffs and dragging consumer spending down with them. This happened during the 2008 financial crisis. Opaque subprime mortgages poisoned bank balance sheets, transmitting Wall Street's panic directly into Main Street households. In Path A, the stock market's decline triggers a systemic collapse of the credit markets that businesses rely on to survive. But there is an alternative route. Path B occurs when a massive stock drop strikes a banking system that is well capitalized and relatively healthy. This chart tracks the S&P 500 leading into the fall of 1987. The index plunges precipitously right here at the end of October. Automated portfolio insurance models instructed institutional investors to sell as the market fell, creating a vicious downward cycle. And this graph tracks implied volatility over that exact same window. Notice the massive vertical spike as billions of dollars in paper wealth vanished in hours. But commercial banks weren't exposed to those specific toxic assets. We saw this again during the 2010 flash crash. High-frequency trading erased $1 trillion in minutes, yet the real economy remains stable. In Path B, a ferocious fire burns through the stock exchange. Because commercial credit lines remain intact, everyday businesses keep operating, and the broader economy escapes untouched. The determining factor between Path A and Path B often comes down to the immediate intervention of the central bank. During a crisis, the Federal Reserve isn't actually trying to inflate stock prices to save investors from their own bad bets. Its true mandate is to step in as the lender of last resort. By immediately injecting cash and liquidity into the system, the central bank ensures that terrified commercial banks have the confidence to keep lending. We've also built mechanical guardrails from past trauma. Today, major exchanges use circuit breakers that automatically halt trading during a freefall, forcing humans and algorithms to pause and reset before the panic spirals. Post-2008 legislation, like the Dodd-Frank Act, requires financial institutions to hold enough reserve capital to absorb a sudden shock without defaulting. These interventions and regulations form a firewall. They can't stop the initial speculative fire from starting, but they are built to keep it from spreading to the groundwater of the economy. As technology evolves, the speed of these market corrections will only increase. We will inevitably see more terrifying, chaotic spectacles playing out across trading floors and computer screens. But evaporating paper wealth, as frightening as it looks on a chart, is primarily a localized event for investors. A digital panic on Wall Street does not shut down the physical reality of everyday commerce, so long as businesses can still fund their operations. A stock market crash only becomes an economic apocalypse when the hidden plumbing of credit breaks. Long-term economic health relies on the resilience of that system beneath the surface. Artificial intelligence companies are currently absorbing trillions of dollars in global capital. Valuations for chip makers and software developers are climbing at a steep pace, supported by widespread market hype and the promise of a significant shift in how global industries operate. This diagram illustrates the mechanics of a financial bubble. The flat line at the bottom represents the actual profits these companies generate. The rising line above it tracks the stock price. A bubble forms when the price investors pay for a share detaches from the earnings the company actually produces. As this gap expands, the investment logic changes. Investors stop buying based on current revenue and start buying based on the assumption of future dominance, prioritizing projected growth over present profits. This creates a self-sustaining cycle. As prices rise, new investors buy in to avoid missing the trend, which pushes the price higher still. Over time, this momentum can lead the market to ignore traditional financial metrics entirely. While AI technology is new, the speculative overvaluation funding its development is a repeating historical pattern. To see where this pattern leads, we have to look back to the late 1990s and the rise of the commercial internet. By early 2000, internet companies were valued almost entirely on their perceived potential. In March, the Nasdaq Composite Index surged past the 5,000 mark as capital poured into any business with a .com suffix, regardless of its profitability. The bubble burst when these companies began to run out of cash. Without enough revenue to cover their high marketing and infrastructure costs, they could no longer sustain the growth rates investors had already paid for. The result was a market-wide collapse. The Nasdaq lost 77% of its value, erasing $5 trillion in wealth. High-profile startups like Pets.com went bankrupt, contributing to the economic recession of 2001. The .com era demonstrates that technology with genuine utility does not insulate a market from the mechanics of a financial collapse. A correction in AI valuations could be triggered by high interest rates, a slowdown in corporate adoption, or failing to meet revenue targets. But the mechanics of a modern sell-off are different and potentially more volatile than they were in 2000, largely because of the rise of high-frequency trading. Today, automated algorithms execute massive blocks of orders in milliseconds, offloading assets without human intuition or the delay of a manual trading floor. This speed was demonstrated during the 2010 flash crash. Automated algorithms drove a nearly 1,000-point vertical plunge in the Dow Jones Index, erasing $1 trillion in market value in minutes before the system could stabilize. These programs create a self-reinforcing feedback loop. When one algorithm sells, it pushes the price down, which triggers programmed stop-loss orders in other systems, generating a rapid wave of automated selling. If AI valuations begin to slide, these trading programs could convert a standard market correction into a system-wide panic. During periods of high volatility, some algorithms use a tactic called quote stuffing. By flooding exchange servers with millions of immediate orders and cancellations, they can clog the system and slow down the execution speeds of their competitors. To counter this, regulators use market-wide circuit breakers. If the S&P 500 drops by 7%, the exchange automatically halts trading for 15 minutes, as it did multiple times during the market volatility of March 2020. But these pauses can create a magnet effect. As the market approaches a 7% decline, investors and algorithms often accelerate their selling to exit their positions before the halt locks them into a falling market. In this environment, the automated systems executing the trades can be as destabilizing to the market as the volatility they are designed to manage. A digital collapse on Wall Street eventually moves into the real-world economy through two primary channels. The first is the wealth effect. When trillions of dollars in asset values evaporate, consumer confidence drops. As retirement accounts and personal portfolios shrink, households often reduce their discretionary spending. The second channel is the rising cost of capital for businesses. Falling stock prices make it harder for both AI startups and established corporations to raise cash. To preserve capital, these firms often implement hiring freezes or staff reductions, slowing corporate expansion. When consumers spend less and businesses stop hiring at the same time, the contraction in the stock market begins to manifest as a broader decline in economic activity. The human cost of these cycles is real. When over-leveraged individuals and businesses are wiped out, it can take years for household wealth to recover. However, the aftermath of the dot-com era offers a specific perspective. The crash removed the speculative noise, but the companies with fundamental utility survived to build the infrastructure of the modern internet. We're likely seeing a similar pattern today. There is a distinction between a company's market value and the long-term utility of its technology. A market crash may erase trillions in speculative value, but the underlying AI infrastructure will remain integrated into the global economy.